It's all good for a trader to look for setups and try and identify the best place to place a trade, but how do you actually place a trade? How do you actually go from seeing an idea and then drilling it down and having the confidence to actually place a trade and filter out the bad trades from the good trades, but then actually get involved and place your stop loss and your target? How do you do the whole thing from scratch? In this video, I'm going to share with you a situation right now on the pound yen and a trade that I'm looking at taking it personally. So let's get stuck in. So this is the pound yen. We're looking at the weekly time frame, and the reason I'm looking at the weekly time frame is because I want to zoom out a little bit, and it's important for traders to zoom out a little bit. We're seeing a lot of bullish momentum at the moment, and on a lower time frame, like the 60-minute time frame, if you drill down, or a lot of traders start looking at these lower time frames and they see a bullish momentum and they go, right, now's a good time to buy, and they just jump in. So what I like to do first of all is jump out to the weekly, and it looks even stronger, right? But the reason I like to go out to the weekly is because it gives us a bird's eye view of where we're at in terms of historical events. All right. Now, it just so happens that we have to go out to the weekly to zoom in and see the previous level of resistance that we're just about to hit. Right. So the resistance, you guys that are into technical analysis, the resistance was here in June 2015. It's been 9 years nearly since we were ever trading around this price. And when we last traded there, we had what we call a head and shoulders setup, right? So very roughly drawn. There was a head and shoulders setup here, upward slanting head and shoulders setup, which we never tested again until today. And today, price is pushing up there with a bit of with a strong bullish momentum. Now, one thing I like about strong bullish momentum is when we approach previous structural resistance zones like this, one, we know that bullish momentum doesn't go on forever, and we can usually identify some deceleration that gives us confidence in a potential rollover, a shorting opportunity, right? And then our job as a trader is to basically stack together as much confluence to give us confidence in a position and a prediction that market is likely to go the way we think it's going to go, and then build rules around getting involved with that move to capture that profit. And that's basically all trading is, as you guys know. So what we're going to do is just take a look at building a case for putting this thing to rest, right? And the first thing is obviously this major structure resistance zone. So if you go horizontal line, and you look at where we're trading at right now, bang, straight in that resistance zone. No doubt. The next thing we can do is use our technical analysis skills. So trading is about pattern recognition. And the more that you're in the markets, the more you'll see that there are certain patterns like this ascending channel, where if these ascending channels start to form, they have a high probability of a rollover. When you combine that with the fact that we are at major structure resistance and there's a ascending channel, we've now increased the probability of a rollover, right? What else can we do? We can now look at things like stochastics or MACD or RSIs and things like that, and look for some form of divergence, right? Whenever you have higher highs in price, lower highs in the stochastic or the RSI or whatever you're using, that is a indication that there's a misalignment in what price is doing and the truth. Okay, so there is likely to be a rollover. Now, when you stack all three of those together, there's an even higher probability of a rollover, right? Other things you can do, you can look for even handle numbers. We're approaching 194 flat. That is a dead even handle number, which has a psychological impact on the behavior of people's decisions in the market. Why? I don't know. Who cares? Why do you go to the fuel tank on your car and fill up the fuel and try and get it bang on zero? Why? Doesn't matter. You're just going to pay by card anyway, right? So these things, we don't know why we do them, but we do them. And when you can start to build a case like this, you can start to, really get some confidence in your decision making. And also, this is where I talk about dynamic trading, which is basically having a way of aggressively or conservatively adjusting your entry, your position size, your target position, and your stop loss position. So depending on how confident you are, if you're confident on a scale of 1 to 10 and you're 10, you might just have the most aggressive entry, the most aggressive position size. You might shoot for a massive reward to risk profile, right? Or if it's a 1 or a 2, you might need a very conservative entry and a conservative position size and a conservative stop loss and target. And I'm not saying you adjust all of those on every trade, but you might have a more aggressive entry, which means a more aggressive target taking, or you might have a more aggressive entry, which means less target taking. It's just a quicker in out, right? So all these things, the more dynamic you can be with that, and the more rules you can build around that dynamic is going to make you a better trader. That's why over the years, last year, the year before, this year, I'm right a lot now, and my equity curve is much better as well. So I'm not only am I growing more and more profit, I'm right a lot. I'm taking more trades instead of less, and I'm still maintaining that strike rate, which comes with obviously experience, but ultimately what that experience is dynamically approaching the market and having rules for every situation, and that takes a long time to build up. So how else can we build confluence here? Well, look, one of the things I'm going to share with you is this tool, which you guys should all know about now because I've spoken about this tool many times before. This is Forecaster, and if we actually look for pound yen, one of the things I want to take a look at is just the seasonality, and the seasonality will show us trends or historical trends of how price moves in seasons, okay, in different periods of time. So if you can look at the last 5 years and say, well, when was the pound yen bearish or bullish over a 5-year period, and it can give you specific time frames in the year of which that has the odds of going up or down, that'd be pretty useful. Well, imagine if you could stack the 5-year, the 10-year, right, the 20-year, and you can look at all of these in one go and see like confluence between them all, see a pattern between them all. Well, look at this. Let's just look at where we're at today, and we're at the high. And over the next couple of days, there has been a very, very strong correlation of bearish movement. So what I'm going to do is I'm just going to grab this on this line. So let's just say where we're at today for the next day or two, right? So 20th to the 20, what is it? 20th to the 21st. So yesterday, let's just grab another day there. 22nd, right? So 20, it's the 21st today. I've gone from the 20th to the 22nd, which is a day either side. And you can see clearly that there's correlation in a downward move there. Now, if we scroll down, you can see that it's not a very good opportunity for a long, right? 20%, 10%, 40%. But if we switch that to short, bang, we've got 80, 90% strike rate, 60% strike rate, right? Now, to go even further with that, if we look at the actual days, today, 100%, meaning that over the last 5 years, there is a 100% strike rate of the pound yen going short to a degree today. And this means that over the last 10 years, there is a 100% strike rate that the pound yen has gone short to a degree today. Make sense? And over the last 20 years, you've got a 71% strike rate. So out of all those 21 years, today, the 21st, Thursday, there has been a 71% strike rate of the pound yen. going short to a degree. Make sense? Now, I don't know if that excites you, but it should excite you to a degree because it gives you belief that there are patterns that happen in the market. That's basically what we want. We want the patterns and we want the confluence. So when you then combine this data with the fact that we've got, let's just change this screen back here. When you combine this data with the fact that we've got this, right? That's great. You know, that can give you some really great aggressive confidence. Now, how do you actually get involved? So that's the question, because I'm not trading the weekly time frame here. So what I would do is this. Whoops, let's go down to the daily, just to double check the confluence, right? So we're still, yeah, we've got our wedge, drop down to the 4 hour. You can see we're starting to decelerate here, and we're having a real hard time pushing above this 193 level. So as we drop down to the trading time frame, what we're really looking for is an entry technique. So for some of you, that might be a 3-bar reversal, or a tweezer top set of candles, or a high test wick, or a doji, or something like that, maybe on the higher time frame. But what you've got here is this amazing double top, okay? And you've got equal tests of high on the price, right? So literally flat equals there. You've got time symmetry and price symmetry on this V top. Beautiful, right? You've got rejection candle at each test. This one's still in play. But the other great thing about this is you've got this overbought condition with divergence on the RSI as well, which makes up for a real strong entry for a double top. Now, on the close of this candle, in fact, this is actually already completed. I'm actually already in this setup. But if you are waiting for this, you could either wait for the close of this candle, or the previous candle actually was valid as well, because it tested this high, but didn't break and close above the high of the candle. So now it's just a case of creating a new order, and literally at market, you can get in with confidence. Bang, you're at the top of the high. You're at the top of the double top. That's a great entry point. And then it's just a case of placing your stops and targets, right? Now, for the stops for this would be at ATR above the high, bearing in mind that you've got to be prepared to potentially be stopped out and get in again, because until we're out of this zone looking left, it's still a great zone for entry, right? And we might not be right the first time, but you want to be right the second time or the third time and make up for the loss. That's the whole point of stacking reward to risk ratios in your favor and being right more than you're wrong, etc. Right? But now we're in this, an ATR based stop above the highs, right? So you could stick an ATR based stop above the high. Stop loss is going to go up at 193.70, 193.73. Okay. And your target, if you're conservative, you can go at the low, but this isn't really a conservative setup, is it? It's a once in a 9-year setup with a 70% strike rate over 70 years, over 20 years, and a 100% strike rate over today, over the last 10 years and the last 5 years, right? So that's not really that's not really a conservative entry for me. And it's also not really a conservative target taking for me. Okay. What I want to do is drop out to the higher time frame here and look at where I've got room to move. Okay. So look, the start of the channel, those of you who trade ascending channels, for instance, and you're looking at that weekly, you've got a massive, you might be trading this and trailing it down and, locking in thousands of pips of profit. For me, I'm a trader and I want to get out, relatively quickly, but still have a good reward to risk profile, still have, still have a great strike rate and everything, but I want to get in and out and I want to get onto the next one. So looking at room to move, if you look here, This level here is obviously the most obvious inside structure level of previous resistance, which price may have a, struggle getting through that, right? The next level is the start of this channel here, where you can see this kind of pregnant pause, and some of you might want to not want to fight through that. What I'd be inclined to do here is to place a stop loss where I've placed it. Take targets here, initial targets, and then trail stops to lower targets. Okay, and I would want to be out here, to be honest, in this particular situation. So it's a 3-to-1 to my target 1. Soon as that's hit, I can then trail my stops to squeeze any more profit out if price is going to get lower and take out this one, which would probably make this a 4-to-1 trade. Okay, so that is a great top down of how you can build a case for entry, then actually enter. So it's all about making a prediction, using your technical analysis skills to build a real tight case for entry. Use that to dynamically adjust how aggressive you are on your entry and what you look for as the entry and where you place your stops and targets and position size and all the rest of it. And then having an actual entry technique. So something you've tested, something you know performs, and you have set rules on, if this happens, then I do this. And if you have all that, you're good to go, right? So going to tip out our profit target order here, 191.86. So 191.86. And I'll come back to this one and let you guys know how it got on. All right, so hopefully that whole top-down approach was valuable to you guys. Let me know in the comments how you're using this dynamic approach as a trader, or if you're not using it at all, let me know if you're going to consider using it going forward. And if you want to see more videos like this and these are helpful, please let me know by hitting the like button and leaving a comment below so that we can continue producing the right content that you actually want to watch. So until next time, guys, good luck in the market. Keep me updated with your progress, and I'll see you in the next one.